Stephen, away from the politics and what's happening in trade, this actually has an impact on the markets.
Yeah.
What is fair value for treasuries right now?
Well, it's a good question because I'm pretty sure this matters for some of the sectors, and that's why there's this huge attention to the announcement. But to me, the overall impact on global growth is not good. And if you think about what a 10-year Treasury is, it's a discounting mechanism that is building in a view for growth in the coming years, not just the next few months, and it's not good. And don't forget, the global growth position is pretty weak. We have lost about 1% from expectations a year or so ago. So growth forecasts have come down globally, collectively, by about 1%. So the 10-year Treasury is reflecting the global picture, which is not as positive as it was a year ago. Now, all of this news flow and the details about which sector will win or lose is important, but net, it's not good for global growth, and therefore it's appropriate to think about what the policy response is, and that means low rates and low rates for longer, and therefore you have a 10-year Treasury yield that yields a lot less than it did 6 months ago.
Steve Major, thrilled you're with us for this morning. Let me ask the question that everybody wants to know. Reaffirm your trajectory of the U.S. 10-year yield. Can we actually get under 2%?
Yeah, well, the forecast we have is 2.1 for year end. It could easily go lower, Tom. It could easily overshoot. It's really a function of how the market starts to build in the expectations for the rate cuts that might come in 2020. And for me, looking at bonds, if I'm thinking that the rate cuts are coming next year, I want to start buying bonds ahead of that. And that's why we think that yields would be lower rather than higher by year end.